Lately, the housing market has been feeling like one of those chaotic episodes from the show Office. The only difference is that in the show, you have Michael Scott, who tends to be very unpredictable, funny, sarcastic, mean, friendly. And in the housing market, we have the interest rates that have been acting very much like Michael Scott lately. They've been unpredictable, going up and down, causing all sorts of chaos in the market. Let's also remember Dwight Schrute from the show, who always acts as a superior to everyone, tries to bring some sort of structure and order to the company, but rarely anyone takes him seriously, and the chaos persists nonetheless. A perfect resemblance of the Federal Reserve lately. The Fed has been trying to bring some structure and order, attempting to slay the inflation dragon by hiking rates, but lately their effort has been met with very little success as the inflation rate remains stubbornly high. I said this before and I'll say it again. The Fed created the same inflation monster they're fighting today. Very much like Victor Frankenstein from the famous novel, who created a monster but then lost the control of his own creature. Then the monster ended up seeking revenge on its own creator. Unlike Frankenstein, the monster, inflation is not a new invention, but the Fed has definitely given it a new life. If you want to learn more about the latest CPI report, we have a video breaking it down. I'll have a link in the description below. In today's video, however, we will talk about the chaotic state of being of today's housing market. My name is Vitaly. As always, I really appreciate you tuning in. And while I have your attention, if you could smash the like and subscribe button, I would appreciate that even more. Without further ado, let's dive right in. January turned out to be a very hot month for the housing market, and it was to no one's surprise. Usually once people get through the holidays and the new year starts, it's normal to see an increase in activity, and January 2023 was no exception. But what really pushed the home buyers to jump back in the housing market in January was a slight drop in interest rate. The rates averaged around 6% in the week ending January 19, down from 6.3% the week before. The drop in mortgage rates was primarily driven by an inflation data from the month of December, which lined up with the economists' expectations. The inflation rate fell from 6.5% in December, down from 7.1% in November. On top of this positive news that fueled the housing market, the Fed also announced that they would hike the federal funds rate only by 25 basis points, a way more moderate increase compared to previous aggressive rate hikes when the Fed would go as high as 50 or 75 basis points. All this combined sent a very positive message to the financial markets. For a brief moment, it felt like the clouds were gone. Inflation felt like something of a distant past as the Fed appeared to have its grip on it. Investors were optimistic and the stock market was ripping. Nasdaq rose over 10% for the month of January, while S&P 500 gained 6.2% for the month. Meanwhile, in the housing market, mortgage applications surged by 25% on seasonally adjusted basis from the previous period in the week ending January 13. On a year-over-year basis, purchase applications were still down by 35% during that period, but the trend seemed to be reversing. Buyers had some breathing room and they were taking advantage. Pending home sales for the month of January also came in hot, jumped by 8.1% compared with December, but still down by 24% year over year. This data certainly painted a picture of an improving housing market, and most real estate agents and loan officers finally felt like we're back in business for good. Little did we know that this trend would be short-lived. As February rolled in, so did the turbulence. The February economic data came in like a wrecking ball, beating any sense of optimism out of the markets like an old rug. The inflation rate peaked at 6.4% compared to 6.5% in January, while the so-called experts predicted 6.2%, which couldn't be more off. The CPI report showed that the cost of goods and services has risen across the board. The data showed more concern than optimism, and once again, the inflation monster is in the spotlight, making everyone wonder what the Fed is going to do about it. But what else can the Fed really do besides hiking rates? This is exactly what causes all the chaos and turbulence in the markets, including the housing market. Mortgage rates climbed dramatically from 6% in January to 6.8% by the end of February, hovering very close to 7% mark. This huge jump was pushed by the inflation data and expectations for yet more aggressive rate hikes from the Fed. One might say, well, when the Fed raises the federal funds rate, that increase doesn't directly impact the mortgage rates, right? Correct, but it's more complicated. The mortgage rate isn't directly linked to the federal funds rate. It's closely correlated to the yields of the 10-year Treasury notes. And when the Fed hikes the federal funds rate, investors tend to flock towards more secure investments such as bonds, including treasuries. The demand for these assets increases and so does their yields, and for the mortgage-backed securities to remain competitive, the mortgage rate has to go up as well. Unlike the mortgage-backed securities, treasuries are guaranteed by the government, and as such, they tend to be more attractive investments in turbulent times because the investor is guaranteed a return. On the other hand, mortgage-backed securities are backed by actual mortgages, which in turn can become risky investments when the housing market isn't doing well. To attract more investors, these securities have to offer a higher yield than treasury notes. This is why mortgage rates tend to go up when the Fed hikes the federal funds rate. Higher yield treasuries can also have an impact on the stock market in a number of ways. For one, when the yields on treasury Treasury rise, it can make stocks look less attractive in comparison, which could lead to investors selling off their stock holdings and moving into Treasuries instead. In addition, higher yields in the bond markets could translate into higher borrowing costs for businesses. This in turn could affect their profitability and lead to a decrease in stock prices as investors become wary of investing in companies perceived to be at risk of decreased earnings. As we are recording this video, the 10-year Treasury yield peaked at 4% for the first time since November last year. The average 30-year fixed mortgage rate is hovering at 7%. The stock market has also been on a decline, and all this is because of very mixed economic data for the month of February, as everyone anticipates more aggressive rate hikes from the Fed going forward. On Wednesday, the Minneapolis Fed President Neel Kashkari said that a 50 basis points hike could be on the table during the next policy meeting on March 21st and 22nd. Today, we're certainly noticing the impact higher mortgage rates have on the housing market. To put things in perspective, we will refer to housing data from Redfin. For the week ending March 2nd, average 30-year fixed mortgage rates rose to 6.65%, marking the fourth straight week of increases. Mortgage purchase applications during the week ending February 24th, people who are applying for a loan to buy a house, declined 6% from a week earlier, reaching their lowest level since early 1990s. Purchase applications were down 44% compared to a year ago. The monthly mortgage payment on a median asking price home was $2,520 at a 6.65% mortgage rate. That's an all-time high. Monthly mortgage payments are up 28%, $556 from a year ago. Month of supply, a measure of a balance between supply and demand, calculated by the number of months it would take for the current inventory to sell at the current sales pace, was 3.5 months, down from 4.4 months a month earlier and up from 2.1 months compared to a year ago. On a month-over-month basis, inventory has declined. The current inventory is still pretty low, showing that high mortgage rates also impacts homeowners and potential sellers, keeping them from listing their homes on the market. For someone who purchased their home 2 or 3 years ago, selling right now makes very little sense unless they are driven by a certain life event. Otherwise, why would they sell and give up their low mortgage rate only to incur a much higher mortgage rate when they purchase their next home for a much higher price? This is one of the reasons I believe the inventory is still very low, and it allows for home prices to remain relatively high, although they have been declining lately. A recent article from Redfin shows that a total value of the US homes was $45.3 trillion at the end of 2022, down 4.9% or $2.3 trillion from a record high of $47.7 trillion in June, the largest June to December decline in percentage terms since 2008. The decline in home values was primarily driven by the rising mortgage rates, putting pressures on homebuyer demand. Make no mistake though, the total value of US homes still remains roughly $13 trillion higher than it was in February 2020, right before the pandemic. To conclude, how things will unfold going forward will entirely depend on how inflation responds to Fed policies. As of today, inflation has been stickier than anticipated, and the Fed is expected to keep hiking rates, which will put more pressure on mortgage rates and home prices. The current federal funds rate is at 4.75%. Fed Chair Jerome Powell warned us last year that it might pass 5%, and now it looks like it will, and it shouldn't surprise us. What was surprising was the latest inflation report that showed very little movement, challenging the Fed to do a lot more damage than they have already done. That's all I got for you today. If you watched to the end, thank you so much for your time. Stay safe and stay informed. See you next time.